think we're live.
Good morning.
We're there.
Oh,
I think we're on.
it didn't beep or anything.
No,
yet.
it didn't. It changed. What's going on here?
Usually we get an alert that you're going live and this is being recorded. So good morning. This is kind of the start. Megan and I have been sitting here chatting for a while, and all of a sudden it's 10 o'clock, and that kind of snuck up on us. Such a phenomenal time to be in real estate. A weird time, a hectic time, a stress time, all the things. But when I think about the perspective of the homeowner right now, the stability and the security is literally off the charts. You have so many people that are locked in incredible interest rates, and it's not coming on as new listings because they're good. Like, they're stable, they're happy, right? Buyers have been locked out for years. They're trying to get in, they're trying to find that perfect home, but they're being picky. So even though there's less inventory, they're waiting for the perfect house to come on. They're not offering, although they're seeing a ton.
They're looking a ton. There are not as
Yes.
many offers being written. Buyers are being
Yes.
really discerning about what they choose to put under contract right now.
Yes.
And there isn't a lot of money left over to go through and make renovations on the property because affordability is such an issue.
That's so
And
true.
so buyers want turnkey homes right now.
And I was listening to a report, they were talking about Macy's, which I thought was really interesting because I was just like, who shops at Macy's?
I haven't. Piper wanted to go there for some weird reason the other day. She's like, let's go to Macy's. And I'm like, why do you want to go to Macy's?
Why do you even know Macy's at
what's about
Piper's
going
age?
to Macy's?
Oh my gosh. So yeah, they're talking about Macy's this morning and how they're having record sales. And they're talking about the fact that these big retail chains, anybody who made it through the pandemic is now doing extremely well. And you see that in a lot of industries, right? When you make it through the worst storm. And I would say the same thing for the real estate industry. Those real estate agents, those lenders, those title reps who make it through are going to be even more successful because you're going to have more market share. That's what Macy's was talking about this morning. But they were also talking about the fact that this recession was really kind of being created by the choosiest of buyers. It's like they're spending the money. We see that they're spending the money. The sales are up, retail sales are up. Obviously the Macy's stores we were talking about that were up. And we're also seeing that that's impacting inflation, which we're going to talk about on the second half, but they're being discerning because everything is more expensive, but they're still spending. So which goes right into housing perfectly. So that's where I got my quote today, because so many of us want to go dark. It's the Wild West out there. It's really hard out there. It's stressful out there. I don't know where to find my buyers. I don't know where to find my sellers. I've been talking with a lot of agents one-on-one here in my office, trying to mind map at some sort of a marketing plan or branding. How do you identify and distinguish yourself against the social media or the news or so many of the big things? How do you focus on the positive when everybody else wants to go negative? Because housing is still one of the best secure industries to be a part of. So here's my quote.
I'm so excited.
I may look calm, but in my head, I've slapped you 3 times. So, bring it down, say the piece, get after it, do the work. This market right now, you have to work harder than the next guy. You have to be more strategic, more creative, come up with more solutions, and be more diligent in your craft to be able to conquer what your clients need you to be, right?
Yeah, it's a year of skill and not of speed.
It is. So with that, Miss Megan, let's talk real quick. What's looking for this weekend? What are you doing?
You know, well, what my plans?
Yeah, what are your plans?
I've got the kids this weekend.
Oh, okay.
So we've got a birthday
kids.
party on Saturday, and then on Sunday I promised them that we'd go swimming, and I have to swim with them, so I'm going to get my hair wet. So I'm washing my hair on Sunday.
Big plans.
Big plans.
Big plans.
Big
Yes,
plans.
Peter and I are going to the mountains, so I'm very excited. We're going to get out of the real estate market for just a hot minute.
Nice.
Just a hot minute. So what are we expecting for the real estate market this weekend?
You know, I think it's going to continue to pick up. We ended up seeing that purchase contracts ended up going up pretty significantly this last week. So buyers are starting to put more properties under contract. They're looking at fewer properties before going under contract. So they're not being quite as looky-loo right now. They understand that the market has picked up, but there's this real interesting disconnect between buyers and sellers right now.
Yes, there is.
Sellers think that it's still 2022 and at the beginning of the year where they can just get away with anything. Whereas buyers think it's 2008. And we've got this weird disconnect. And so it's so important that you guys are tuning into this every week and watching the numbers, because we want to make sure that you guys are having the up-to-date information so you can share with your clients what's happening in the real estate market. And that's why this weekly report is so important, because the monthly numbers don't tell the story anymore. It's the weekly numbers that we have to look at, because the market continues to gain steam and momentum. We're in this compression point where we have more buyers in the market than homes to sell them. And I'm hearing multiple offers, not across the board, but more frequently than not. I try really hard to go through and call all of my clients that send in new orders each week. And I ask them, how long were you on the market and how many offers did you get? And it seems like it's about a third, about 33%, 35% of them are in multiple offers again. And so they're not the multiple offers that we were seeing last year, where we were going 8 to 10% over asking price, but we're looking at 1 or 2% over asking price right now is what's getting these properties under contract in these multiple offers.
But you're seeing some properties are going for 8% over. I mean,
Yes.
depending on the location, depending on how perfect the home is, depending on the staging, the photography, all the things.
Yes.
Right? Those perfect homes are literally getting, I mean, there's a lot of buyer interest in them right now.
There is. And again, buyers don't want projects. They will pay extra to move into a house that is turnkey. And so it's so important that you're doing your updates, that you're doing your pre-inspections, that you're correcting those items ahead of time before listing that property for sale, because those properties that are turnkey and show ready are going for premium prices, because again, buyers don't have money left over to go through and make renovations immediately.
Right.
They know that they're moving into a home and they have to live with it in the current condition that it's in for at least 5 or 6 years before they're able to go through and make those renovations on the property.
And buyers are getting a little used to rates in the 6s, I would say, right?
Yes.
I mean, some of them have just acquiesced, saying that I'll refinance. Some of them see the bigger picture beyond, and some of them just have life happening and I need a bigger home. We're pregnant, we're moving, we're getting divorced, we just graduated, whatever the situation is, that is still happening. And that pent-up buyer demand wants to get in, but they're being discerning. That is the big key. So as long as we know that going in, we can have those conversations with the sellers and then right size the buyers. And they're also a little confused. So we have to be the guide when it comes to educating them, because they'll see one headline that says rates are going down and another headline rates are going up, depending on when the Freddie Mac reports come out or where rates are headed. But they're not pretty today.
No,
they're going up again.
Are they? Where are they at today?
So the 10-year just crossed over the 4% mark, which is bad, because that's when we got up to the 7.25 last time.
Yeah.
So the job numbers just came out strong again, or not the jobs number, sorry, that'll happen next Friday, but the initial jobless claims just came out, and it's again another week where it's below 200 and the market didn't like that. So we're going to just continue to watch that, but the rates are crossing over. They're getting dangerously close to 7, above 7. So we just have to talk about the 2-1 buy downs. We have to talk about the permanent buy downs. We have to talk about the ability to refinance. I know what our team is doing as far as the no lender cost refinances. So getting strategic and having those conversations.
Let's go ahead and get into the numbers.
Yes.
Let's pull this up. Share. So let's see here. So this covers the week of February 22nd through the 28th of 2023. So now we're out of Super Bowl weekend. We're out of President's Day weekend. We've now seen this nice pop of buyer activity that's really started to come through. And again, we're getting into our strategy sheet here where we're really filling into the red, where we have March and April as your best timeframes in which to list.
And really in March and April, just to highlight, really, we're only talking about spring break. Otherwise, there's no real holidays or any.
We've got Easter in there in April.
Okay.
And so Easter weekend tends to take about a 10% hit in the marketplace. So I would avoid spring break for whenever your school district is. Usually spring break is going to be the last 2 weeks of March, depending on it for 1 week. And so if you are faced with having to list over spring break, I would get it to market the weekend before instead of the weekend after, because we end up seeing a lot more new inventory make its way to market, because a lot of parents end up taking that spring break week to get their home spoofed up and ready for sale. And then we see inventory going up the week following spring break in different school districts. So you want to get it to market before that. Avoid Easter weekend. Again, religious-based holidays, that it's, even though we don't have a 3-day holiday weekend, when it comes to Easter, people are spending time with families on Easter, going out for brunch, doing Easter egg hunts. And so I would avoid that weekend as well. That ends up taking about a 10% cut overall. But we really are coming into the heat of the market where it's the best time to list and be a seller in this particular market. Looking at our strategy sheet Pete filling in for this last week. It heated up to our fastest week so far this year. We've got a lot of new listings that are starting to make their way to market. Our average daily active count came down again week over week. And again, our average daily active count tends to come down until about the beginning of April when we start to see those new listings post spring break make their way to market again. But we still only have 3,636 active listings available for sale. And I threw out an interesting question on social media earlier this week. If you have a buyer, how many homes are you showing your buyers each weekend? And on average, they were saying 3 to 5. Well, if we're averaging about 15,000 total showings each week, that means that if we're looking at 3 to 5 showings, we've got between 3,000 and 5,000 buyers that are out there in our active buyer pool right now. And I would tend to think that it's probably on the higher range, where we've got about 5,000 active buyers in the marketplace right now looking for a home because of the multiple offers that we're starting to see. But pending transactions this last week ended up jumping by 9.1%. So we're starting to see more units going under contract as buyers are starting to feel like their feet are being held to the fire in these multiple offer situations again. Expired listings end up jumping at the end of the month because of the way that you guys write your contracts. They expire on the last day of the month. And so we ended up seeing that our expired listings went up by 95.7% just over this last week with 227 total units expiring. So if you're farming for those expired listings, the day directly following month end, so the first of the month is a really good day to get on RedX, which is a platform that you can use to get homeowner information for those expired transactions. It's a great day to go through and farm for those new listings. New listings came up. We had 907 total new listings make their way to market. So that was about a 5.7% increase. But overall, our predictive month supply of inventory dropped by 8.6%. Now we're sitting at 0.8 months worth of inventory, or at the current rate of sales, we'll sell out of all of our existing inventory in about 26 days. Now that's higher than the 4 days, 6 days that we were seeing last year, but that's still an incredibly fast market overall for homes to be going under contract in. The odds of selling is coming in right as we expected it to be for the beginning of the end of February, beginning of March. We want to see this number around 60 to 65% if we're going to get back onto that normal seasonal pattern that we experienced from 2013 through 2019. But the odds of selling were, for the next 30 days, if you listed a property last week, about 63.9%. That increased week over week by about 2.5%. The odds of selling tends to increase until we get to about mid-May, and then in mid-May it starts to pull back. I'm not a big fan of May listings. Again, you've just got too many holidays and too many distractions in there. I really think that March and April are your timeframes in which you really want to be listed in. And so again, in May, we've got Mother's Day weekend, we've got Cinco de Mayo, which falls on a Friday, which may impact the market. Then we've got all of the high school graduations, and then Memorial Day at the end, and that's the kickoff to our summer. And we really see a big tank in the market as we get into Memorial weekend. So again, your prime listing time is right now getting into March and April. Based off of what went under contract last week, we are looking at only 13.6% of a balanced market. And so if we were to have that magical 6-month supply of inventory, which is kind of a pie in the sky wish at this point, with interest rate gridlock, getting up to a 6-month supply of inventory where we would truly flip into a buyer's market is not very likely. I mean, we would need to have 26,700 active units available for sale in order to get up to that magical 6-month supply of inventory. So we have this inventory cushion that's prohibiting us from going into a market where we see distressed transactions. I did have one agent reach out to me though this last week that said that she may have a short sale coming, and it is someone that bought at the peak of last year and ended up losing their job. And so it's a really sad situation, but again, it's not common. Most homeowners, if they do lose their job, unemployment still remains historically low. Was it 3.4, 3.6%, 3.4%? So they're able to go out and get another job very quickly, and they're likely making more money at that new job when they get hired on. And so again, we're still sitting only at 13.6% of a balanced market. Showings actually declined this last week by about 0.6%. We had a total of 14,305 total showings that were set. So I'm going to round that up and call it 15,000. That's why I'm saying that I think there's about 5,000 buyers in our overall market. If you're looking at an average of about 3 homes per weekend, this is probably going to be about 4,000 or 5,000 total buyers that are in our buyer pool right now. But you're looking at about 4 shows per property per week. I had a lot of people reach out to me that were in this kind of Clayton, Cole neighborhoods up in that northeast Denver territory
Mhm.
that said that they had slow showings. And so I went through and pulled out the showing report for them through Showing Time
Yeah.
to see how many shows per property per week they were getting. And it was 4 shows per property per week. They were like, we really thought there would be more,
I would have
but that
thought
was
so too.
that was a slower area for
Got it.
downtown Denver. And so it ended up not being as hot there, but I can always pull those reports for you on a Monday. If you reach out to me, send me an email. I'm happy to help out with that. But if you didn't get 4 showings this last weekend, you might not be in your target time frame and you might need to make a price reduction at that point. People were only looking at 14 homes before going under contract, which was down from the 15.3 that they were looking at last week before going under contract. Now, with interest rates being higher going into this weekend, buyers
Yeah.
could be more discerning because it's impacted their affordability again and what they're able to purchase. So that might end up going up this next week, where we might take more showings to go under contract
Mhm.
because buyers are a little bit nervous about putting something under contract in a higher interest rate environment. So that number does start to change a little bit as we start to see affordability impacted in higher interest rate weekends. I would be thrilled if interest rates would just calm down,
Right.
if
Just
they
a
would
little-
just settle in.
Yes, a little lack of volatility for a minute.
Yeah.
A little lack of volatility. And definitely as a seller, when you're talking about the strategies going into a weekend where you know the interest rates have been going up all month. And right now, we really just need a really good jobs report on the 10th. We need a better CPI on the 14th. And until then, we've got this volatility, this high range.
Yeah.
As a listing agent, I would be calling that lender and asking, are they at the top?
Mhm.
Like, are they maxed out? Because that's where you might have some fear. And if the interest rates are going up, they might be second guessing upon inspection,
Mhm.
right? It's like, it does need that work. You know, as you were mentioning earlier, I want it to be perfect.
Mhm.
So definitely be cognizant of that, whether you're buyer's agent or listing agent, because that might max out and put some fear in your buyer.
Right.
Yeah.
Yeah, it's important that you guys are staying on top of what's happening with interest rates and making sure that you're working with a really great lender like Nicole, who keeps you up to date on what's happening with what you can afford to purchase. And so Nicole and her team, they do a great job at that, staying on top of everything. So I would highly recommend that you reach out to Nicole for that type of information. But again, about 14 showings to go under contract. So if you've had a total of 14 showings and no offers, maybe time to consider that price reduction. Median days on market for pending transaction continues to drop like a rock. We're down another 18.2% week over week, down to 9 median days on market. So it's just over
Speeding
a
up.
week for homes to go under contract, and it's lower at lower price points. We'll go into those numbers in just a couple seconds. Price reductions also came down. They ended up decreasing by about 1.3%, where we saw about 29.9% of all the homes that went under contract last week ended up making a price reduction. And the average price reduction also came down. It was about a 5.2% price reduction, or about $35,000 off of the original price. So price reductions way down from where we were at the end of the year. We were looking at 8.5% price reductions at the end of 2022. Now we're down to a 5.2% price reduction, which is about where I want to see that number
Yeah.
for the end of February. It's usually about a 5.1% price reduction for February
It
transactions.
makes sense if you've cleared out that inventory that's kind of stale and now you're starting to cycle through.
Yes.
What I'm so intrigued about though is how strong all these numbers are to the speeding up of the market. We're heading into spring.
Mhm.
Meanwhile, we just had an incredibly volatile interest rate month, right?
Mhm.
The whole month we went up 1% in 2 weeks. I mean,
Mhm.
that's a lot.
That's a lot.
And so, but it didn't necessarily affect this. I mean, some buyers maybe pulled out, but maybe there's a little bit less inventory to choose from. That supply and demand is staying relative.
Yep.
It's hopeful to see that we're going to have that full spring market that Denver's used to.
Yes.
Yeah.
I'm really encouraged.
Yes.
I was really downtrodden at the end of 2022. I was really frumpy about what I expected to happen coming into the spring. And I've been really encouraged to see the title orders that have started to come in into 2023.
Yeah.
I mean, it's not 2022. We're not going to see those numbers again, but
Right.
it's better than what I thought it was going to be, and it's sustainable. But again, this is why I've been stashing cash for the last 9 years, was in preparation for a market like this, because I got to pay my bills, right? And so looking at the under $500,000 market, again, this market really is hot. Going from March through about May, we start to see a lot more inventory making its way to market. So if you got one of those great listings, you want to go ahead and start getting that ready for to list in as we get into March and April. This market also heated up quite significantly as we got into the next week. We only had 936 total available listings for sale, and that remained relatively flat going into this new week. New listing count was down by 9.7%. So there wasn't a whole lot of new
Wow.
inventory that made its way to market in this under $500,000 segment, but pending transactions went up by 10.1%. So it messed with the relationship between supply and demand, and it dropped it down to 0.5 months worth of inventory. So we're looking at about 15 days to sell out of the existing inventory. We did see that there were more withdrawals and more expired transactions that were up week over week. They're up a lot higher than they were 1 year ago. They're up by 52% or 120%, depending on which metric you're looking at for expireds and withdrawn transactions. But those are definitely happening this year. But we're down to 0.5 months worth of inventory, which is very squarely into multiple offer territory again. Looking at homes for going on the market this last week, the odds of selling increased by 1.6%. Again, this number continues to go up until about April, mid-May. We start to see this number start to falter as more inventory starts to make its way to market and our buyer pool starts to get distracted. This market only has 8.9% of a balanced market. We need about 10,500 total homes available for sale in this market to offset demand. And we're looking at about 6 shows per property per week. So if you didn't get your 6 showings on this property, it might be sign number 1 that you need to make a price reduction. We were looking at about 14 showings to go under contract, 13.6. So if you've had 13 or 14 total showings and no offers, it may be time to make a price reduction. Median days on market again dropped by 1 day. We're down to 8 median days on market in this particular segment. So these homes are moving very quickly just after the first weekend.
Right.
Looking at price reductions this week, only 28% of these homes ended up reducing their price, with smaller price reductions at 4.8%, or about a $21,000 price reduction in this particular market. 500 to $1 million. This is really where we're the most interest rate sensitive category. So this is where I start to see more of the volatility come into these numbers in this $500,000 to $1 million segment right now. But it did heat up this last weekend, making it the fastest weekend to sell so far this year. We have about 2,031 total average daily active count, and that came down by 3.4%. New listings nicely came up by about 8.1%, but they were picked up very quickly with 533 total units going under contract. Pending transaction count increased by 4.3% over this last week. Month supply of inventory, we're sitting at about 0.9 months worth of inventory right now. So again, we're looking at multiple offer territory. If you have a home that's show ready,
Right.
again, you have to take all of your due diligence to get these homes ready to go and get them under contract quickly. But there are buyers out there that are just waiting for that perfect home to pop up for sale. 63.2% odds of selling increased week over week by about 2.8%. Really healthy number. We want to see this number bouncing between 60 to 65%. Again, the highest I'd ever measured this number before COVID was 61% odds of
Oh,
selling.
wow.
And
Okay.
so we're right in there with where
Yeah.
we were from 2013 through 2019 in terms of those numbers. Looking at percent of balance, we only have 14.6% of a balanced market right now. So inventory still remains incredibly tight, even in this $500 to $1 million segment. About 3.5 shows per property per week. So make sure you're getting your 3.5 showings per week. About 13 showings to go under contract. So buyers are actually looking at fewer homes in this particular price segment before going under contract, and they're pulling the trigger a little bit more quickly. So if you've had a total of 13 showings and no offers, maybe time to make that price reduction. Days on market dropped from 14.5 down to 11. So this market is really picking up too. Days on market continues to drop up until about the end of April, beginning of May. And so we're looking at about 11 median days on market right now. 33.4% of what went under contract last week made a price reduction, and the average price reduction was about 5.2%, or about $37,500 off of that original asking price. So that's a pretty significant price reduction. I mean, it's not what we were seeing at the end of the year. I mean, back in November and December, October and November, we were looking at 8.1% price reductions. Now we're looking at about a 5.2% price reduction, which is about average for what we should expect at this time of year. $1 to $1.5 million. Looking at this time frame, March is your time frame in which to list these homes. April looks pretty good too, but inventory starts to go up in April as we get into this over $1 million segment. So it starts to cool off this market a little bit more. We did see that the market heated up this last week with the odds of selling starting to increase. We're now down to 1.2 months worth of inventory. That dropped by 25.3% week over week. In this market, we only have 312 available homes for sale. We had 86 new homes make their way to market in this last week. And we saw our pending transaction count increase by 35.6% week over week. So post President's Day weekend, this market really picked up. All of those folks were off watching Super Bowl, President's Day weekend. They were off skiing. Now they've returned to market, and we put in a 35.6% more units under contract this week than we did last week, with 61 total pending transactions. We saw fewer withdrawn transactions this last week, but expired listings were about 18 of them in this over $1 million segment. The odds of selling popped up to 55.5%, which is a really great number. I mean, those are numbers that we were hitting back in 2020 during the pandemic when things were really hot and on fire then too. And so 55.5%, I'm thrilled with that number. That increased week over week by 6.8%. So we have a really active pool of buyers that are out there right now. They're in these higher price points that are just waiting for this perfect property to make their way to market, and they're going under contract very quickly.
Can I capture your positive energy?
I'm so excited.
I mean, guys, seriously, this is a good market. It's a weird market. It's an off-kilter market. It doesn't feel normal, but you're looking at these numbers. Interest rates went up. Mortgage purchase applications went down, yet all of these statistics, we're still seeing the right properties are turning. They're getting multiple bids. The sellers are happy. They're moving on with their lives. The buyers are getting under contract.
Yes,
there's a lot of positive.
There's a lot of positive stuff going on right now. This market is good. It's not the insanity that we had last year. But we didn't want that insanity again. We didn't want that market. That market was too challenging to work in, but we're still in a very deep seller's market overall. When we look at these numbers, we saw 13.1% of a balanced market this week. We saw about 3.3 shows per property per week. Showings increased week over week by about 9.5%, but our contract activity was really what was outstanding. They were looking at on average about 17 showings to go under contract. So they're still looking at more properties before putting an offer in.
I was going to say that.
And so they're looking at more properties before they put their offers in. Again, it's really important that at these higher price points that you're staging these properties, that you're taking great photos of them, you're pre-inspecting them and correcting all of these issues. Median days on market for those units that went under contract this last week was 5 median days on market for homes between $1 to $1.5 million. So again, you may have to make price reductions more quickly in this market, but price reductions this last week, only 15.8% of what went under contract this last week went under contract with a price reduction. Average price reduction was about 8.2%, or about $116,000 off of the original asking price. 1.5 to $2 million. March is your best month to list in. So get those listings to market. We've got a really active pool of potential buyers out there between 1 to 1.5 million. Every cell across the top of this is almost all turned red. And so again, this market is heating up very nicely. In this market, we have less supply than what we do in the $1 to $1.5 million mark. We only have 1.2 months worth of inventory. Our pending transaction count week over week jumped by 86.7%. We only have 145 total average daily active count. New listings only came up by 11.8%. So some of that aging inventory is starting to come off market, but we're down to 1.2 months worth of inventory. So properties are really just flying off the market here. The odds of selling is now over 50% for 1.5 to 2 million. I'm really happy with that number. That's a really healthy, strong seller's market. Looking at 9.9% of a balanced market overall, about 3 shows per property per week in the $1.5 to $2 million price point. And we're looking at about 14.6 showings to go under contract right now. So about 14 showings should get you a contract on that home. It was 9 median days on market for this particular market. So a little bit longer than the $1 to $1.5 million market, but overall not very much. We only saw 18.5% of them reduce their price with an average price reduction of only 4.4%, or about $84,000 off their original price. So our luxury price points are really kicking off pretty strong. I was down at Kentwood DTC yesterday morning, and they were talking about the over $3 million market and how they were seeing multiple offers in the over over $3 million market for those homes that are in really good condition, that are just great and in good locations. And
This market is, it almost feels like it's becoming more of an over 2 million. Like the idea that we would even talk about over 1 million anymore doesn't seem rational given the
Mhm.
Denver market.
Mhm,
It feels like it's over 2 to even begin to get into the luxury market.
mhm.
I've quoted this conversation. I had a great conversation with a real estate agent talking about something that he was a very small part of, but kind of anyway, let me start that one over.
Well, I'll try again.
Sometimes you end up hitting a dead end. Take
Take two.
Anyway, having a conversation around a series of properties that were purchased in the DU area. And what's interesting to me is how going through and taking old rentals that weren't being cared for, but that students were in, and going through and scraping them and converting them into really $2.2 million homes.
Wow.
That's the target number.
Wow.
And so when I think about that, the $2.2 million range by DU, I was telling my daughter this and she was like, where are the students going to live?
Yeah.
I don't know. Right.
Yeah.
But that's where the market is headed here in Denver.
Mhm.
So we're definitely talking about that more, but I know we've got some questions.
Yeah. So what about
Yeah.
selling in mountain community with a mud season through April? Any thoughts? I would avoid mud season. You don't have as much of that secondary home market that's coming
Mhm.
through. So I would try and list in March so that you've got the ski traffic coming through, or probably wait until May when things start to dry out a little bit more. Mary said, I've seen a few people post about this. Any data to back it up? I do track this. 65% of all contracts in Denver metro area had an average of a $6,500 seller paid closing costs attached to their contract. I can track that through the MLS. It's a tricky tricky thing to go through and pull, but it was about 63% of what closed in January.
I was going to say,
In January, which was meaning that it was under contract in
December.
December,
yes.
was seeing a $6,500
Yeah.
concession. So that was a January closing number based off of what went under contract back in December. When I pull that number this month going forward, I think that number is going to come down. I think that you're going to see fewer of those concessions that are being offered in light of a much more
And the buyers need it because the
Yeah.
interest rates went up again,
Mhm.
but there's just not enough inventory. I don't think the buyers can demand it
they
right
can't
now.
ask
is
for
the
it right
problem.
now. If they want to get the home,
Yeah.
they can't ask for it. So can we expect a new segment focused only on Bob updates? So if you've been following me on social media, I've picked up a stray cat. His name is Bob. He's a neutered male, still looking for his owner. We would love to reunite him with his family, but again, we will give Bob a very happy home until we find his owner. And so I've been stopping myself from buying the cat tree and the big fancy litter box. I've been sweeping litter. This cat is very aggressive in the litter box.
Is he? Oh, that's
It's
unfortunate.
just, I have to say, litter boxes are not my favorite.
No.
But you know, the kids are super happy with the cat.
I
The
bet
cat's
they are.
really happy in the house. So we've got a cat now. His name's Bob.
See, we haven't had a cat since we moved down because we lived in Evergreen.
Uh-huh.
And the moment you try to bring a cat home, it's unfortunate
Uh-huh.
because you just end up losing the cat and you just can't do that. But it's so great to hear about and all the stories of Bob.
Yeah, Bob.
Bob's got to continue on social media though.
Bob,
I don't
yeah,
know if
Bob
we can
has
do market trends
Bob
on
has a big
Bob.
following on social media.
Really quickly, just a couple of extra. The cat is big. We actually were talking about that. She's taken ownership of it now. We're done. From a lending standpoint, how have appraisals been coming back at the start of the year? So we've been getting a lot of appraisal waivers, and I love that. So if you're not asking for or getting those appraisal waivers, definitely something that you want to be running. We're even running them before the offers go in so that the stronger offers can hopefully get under contract saying that, yes, we're offering for more, but we've got an appraisal waiver. You're not going to get an appraisal waiver if you've got a purchase price over $1 million. So just know that. So it does knock out a handful, even if you put a lot down. That's just one of the things that are going to knock it out. But definitely we're using the appraisal waivers whenever we can because we are getting some, depending on the neighborhood, that are coming in low.
Mhm.
But the more we have of the January sales and the February sales, it's going to start pushing out the November and December sales.
Mhm.
Yeah, people don't own cats. Cats own people.
Yes. Bob is definitely running the household right now. I feel kind of bad for my 15-year-old Yorkie. She's getting pushed to the side.
15-year-old.
15-year-old
It's
Yorkie.
easy to push a 15-year-old.
Shelby doesn't sleep. All she does is sleep.
Limited appraisals make for a strong, limited inspections. I'm thinking your thing, roof structure and plumbing. Absolutely doing that in this competitive market. All right, so let's just jump into what's going on in the economy on this side of things, because interest rates are going up. We're continuing to see more economic news that speaks to the strength of the economy. And then make sure at the end, we've got our market update text. So if you want to know kind of where it's going in, every Friday, we send out a text saying interest rates just went up, praise goodness, we've got some interest rates going down, whatever that is that weekend, knowing that if you can help somebody with affordability, or if you know that they're going to be stretched and that that's top of the limit, we're going to give you a topic of conversation and where the direction of the interest rates are going. So we're going to share the screen really quickly. Okay. All right. So let's jump in.
That quote.
I love that quote.
I'm thrilled.
So that quote is what happens when you ask your husband for the quote of the day. I told him what I was talking about, and that's the one he gave me.
Good way to go, Peter.
And I was like, I'm not 100% sure that wasn't directed at me. I'm gonna go ahead and take it anyway. So, all right. So the interest rates, we saw them jump up quite a bit. So we had this relief from where they were at 7.25 back in November, and they had been going down. Obviously, we had a couple of movements in here, but they've been going down until the beginning of February. And then it turned with all the news. And right out of the gate, the beginning of February, we had that very unfortunate jobs number, the very flat CPI number, and then the unfavorable PCE number that showed core inflation was actually going back up again. So all of those things just continue to talk to the stickiness of inflation. And this was what Fed Chair Powell had been talking about. He goes, we can't get off the soapbox of higher for longer too quickly. Otherwise, we're going to have a rebound of inflation. So we kind of got a teaser of that in February. Mm-hmm. So we're going to have to keep watching that. And I think we're going to have volatility for the next several months. Of course, there's some conversation based on year-over-year comparisons. We might see interest rates drop a little in March. We might see them go up a little in April. We might see them go back down in May again. But until we get that consistent month over month drop in core, and we see some of the pull off from how constricted labor is right now, we're really not going to see the Fed being able to pull back on the Fed rate. We're not going to see inflation coming down, and we're not going to see the 30-year fix coming down. So a number of articles are coming out saying mortgage rates have very little reason to fall in March. You're going to get both sides of this coin. You're going to have some economists coming out saying that we think that March will show some favoritism and we'll see some drop in rates, and others saying that we're really not. But it all comes down to these three reports. So on March 10th, and it's usually the first Friday, but because February is a short month, this Friday is not going to be when we're going to get our unemployment and our jobs numbers. We're actually going to get it next Friday. So next Friday, which is a very long time, because if it's good news, I really wished it was this week. Now, if it's bad news, I'll wait another week. But March 10th is the jobs numbers. So that, pay attention to the hourly wages. How sticky is that wage increase? That's going to dictate inflation, and then the number of jobs created. March 14th is the CPI. We've got to look for that as far as giving us any clues as to what inflation is doing. And then March 22nd is the Fed's next monetary policy announcement, talking about how much they're going to raise the rates and what their expectation is for the rest of the year. Mm-hmm. March is going to be another big month.
Yeah, March has a lot of news that you guys need to be following along with in order to set up your strategy for the rest of the year.
It does. Mm-hmm. It does. Because if it goes wrong, I don't know that April will get much better. Then it really will be the next 60 days, which is in total 90 days of kind of this jaunt through the higher rates. But it makes me feel at least settled, seeing what's happening in the real estate market, that people are buying despite that. Mm-hmm. Now, some people are backing off, and I'm going to show you that in the mortgage purchase applications. Some of that demand is waning, which in my mind just literally opens up more opportunity for the buyers who are willing to get into this market, that maybe there's not as many competitive offers, so that they can get in and then refinance, but making sure that those numbers do work and it's within your budget. All right. So the big conversation then is based on these rates and the reports that have come out. We're fully expecting that the Fed is going to raise another 3 times at least. And now conversations have started talking about 4 rate hikes from here out, right? So we were thinking coming into this year that we were only going to see 2. So now to see 2 or more, that is why the market is really not happy. The bond market went, oh, now I see what higher for longer means, right? They were ignoring it because we were on this sugar rush and everything felt good. And the inflation numbers came out really good for 2 reports. And then on the 3rd report, they didn't. So we're really watching this. So this is kind of just saying this is a Fed tool that shows the expectation of the Fed rates. There's even conversations that at this next meeting, they're going to raise it 50 bips instead of 25.
Oh.
So a lot is going to happen at this next Fed meeting.
Okay.
We'll be talking about it.
Yeah, brace for impact.
Manufacturing numbers came out yesterday. So yesterday we had a bad day for the bonds. This morning, we're not having a great day for the bonds. We've been hitting against this 4% on the 10-year treasury for really over a week now, and it keeps wanting to hit it. Well, we broke through that. We barely touched over it yesterday, and then we broke through it this morning. But this is what happened yesterday. So the ICM, the manufacturing came out showing that not only are we turning more back towards services, but that wages continue to be the issue. Supply has loosened up, the backlogs have started to loosen up, but we're still seeing the prices of things increasing. So that really means that the stickiness of that inflation is not subsiding yet. So given that, Bostic came out yesterday morning and immediately reiterated higher for longer. And then several other Fed board members came out right after him saying the same thing, which pushed up our 10-year treasury, which pushed up our interest rates. So as you can see, we were right up against this mark. The 3.99 level was a ceiling. We broke through that. Or 3.90, sorry, was a ceiling. We broke through that. We got up to 3.99 at the end of the day yesterday, and this morning we broke right through it again. So that is where we saw the 7.25 rates last time. So we'll just have to keep watching this as we go into the weekend. Mortgage purchase applications dropped again. So another 5.7% week over week. If I take that backwards, I got to go all the way back to 1995 to see that number. But you still have this massive uptick of mortgage purchase applications that those people aren't gone. They're just slow rolling. They're waiting for that right house. We're seeing it because the pendings are still really good, right? Pending sales were up 50% in January and up again in February. So they're still putting homes under contract, even though the rates are getting higher because they know they have the opportunity that they might not have once interest rates drop down. So I still think we got to work our database is the bottom line.
Yes.
If you're not expecting new people to filter into your database, you've got to actively be working your database. But to see mortgage purchase applications come down, not a huge surprise. The monthly payment on that from February to January went up $444. If I take February 2023 to February 2022, it actually went up almost $1,000 and went up $889. So it has a very real impact on a household's monthly budget and affordability. So it is rational and logical to see those mortgage purchase applications go down, but seeing the spring prime market still commence is good news in spite of this, right? So that's all we can do. We can simply report on this, but we can't be the ones that hype this up because remember, they're not in our business. They're hearing about the real estate market, but they're not entrenched in the real estate market. So it's not stressing them out like it's stressing you out. So you just have to not let it stress them out. Just talk about the reality of what the opportunities are in front of us, how we can get into a home, how we might have to multiple bid. We don't have to multiple bid 10%. We only have to go up 2%, all of those things, right? In context, because sometimes you just want to throw your hands up in the air, but really it's time to stay focused. So let's jump over to inventory really quickly, because where are you, right? A couple things that are going to just continue to keep inventory constrained. Residential construction spending report just came out this week. We're actually down 3.9%. So we're seeing public construction and non-residential construction increasing, but the residential construction is not getting as much money as it had. And then I wanted to just pair that with the report that I shared last week that the build for rent actually overtook the build for purchase for the first time in history. So you're seeing these investors In fact, I was reading a whole report talking about the turnover for some of these investors because they actually have contracts with builders to build complete communities for rent. So whereas they were like BlackRock was coming in and buying all of those homes on the retail market, now they're starting to filter through some of those and offload some of those to redistribute their inventory to whole neighborhoods or to whole communities.
Wow.
Which is crazy to me. So to see these housing starts, all this means is we're going to continue to see inventory really for years. If not, we don't see birth rates decline until those kids today who are 13 years old. So we still have 2 decades where theoretically birth rates are going to put a pressure on demand, that whenever we see the interest rates hit a point where people can afford to get in, we're going to want to see that demand on single family homes or on any homes. And that demand on inventory is going to be an issue. And to have this conversation is the realistic conversation you need to be having with your clients right now, because if they're waiting for something to happen, like interest rates to come down or more inventory to come online, they're putting themselves in a position that's further back. It's literally like getting out of the line and going to the back all the time, right? Every time you got to get out of the line because you're feeling a little hot flash, you have to get to the back of the line again. So having that ability to start building wealth, having that ability to start having stability, having that ability to start building financial wealth has to be a conversation. And you have to be the one that networks in what the news is saying and what the market is saying and what the reports are saying into the opportunity that is available to both the buyers and the sellers. They can't be expected to make that connection themselves. We have to make it for them, right? How do we get through that? And then, of course, I talked about this on Saturday in our live. You know, Bezos has backed Arrived Homes. He doesn't own Arrived Homes. He owns a very large portion of it based on his investment. But this is another one of the things that, in my humble opinion, has just gotten started. They've only bought, and their number of homes owned is in the hundreds right now. I think very quickly it's going to be in the thousands. And they're not buying, this Arrived Homes is not buying complete neighborhoods. They're going back out to market and they're buying for a retail price. They're buying a single family home and they're going out and crowdsourcing the funds. So and Bezos, you got to think Amazon's got a massive database and they're going to go out there and get people intrigued to invest for only $100. We talked about this in a YouTube video, which you can share, talking specifically about why this really isn't investing. I mean, it is to a degree. It's like investing in a REIT, but it doesn't give you options, the kind of options that real estate gives you, that you can cash out refinance, that you can sell it, that you can live off the income, that you can do all these things as you grow older. It is another diversified investment opportunity, but it is also going to be the very thing that continues to constrain our inventory and keeps our home prices elevated. So also found this report. Now I'm waiting for updated data because this is as of the first quarter of 2022. So this is a year old, but it does have state level. And when you get to the state level on these national data aggregators, you're always behind. But this first quarter number actually gave me a number for Colorado, because we always talk about the fact that 62%-ish, right, of homes have a mortgage. So you know that the 38% don't have a mortgage. We've talked about that number for a while because it's just under 40%, 38% of homes don't have a mortgage. That's stability. Here in Colorado, 70%, 71% have a mortgage. So a little bit less. So 30% of them are owned free and clear. But interestingly enough, more of them that do have a mortgage are locked in under 5%.
That's our interest rate gridlock.
That's our interest rate gridlock right there. 92% of them.
Yeah, they don't want to move into a smaller house for more money. Our inventory is not coming up significantly anytime soon.
No. This is, so when I found that, I was like, okay, and there you go. There's your sign.
Yeah.
There's your sign.
Yeah.
So this is definitely something to capitalize on, knowing this information, being able to share it. This is why we're not going to hit a bubble. This is what's going to keep the home prices stable. This is what's going to give those home buyers that are getting feared out of the market that kind of push to get in. Now, we have seen, this is another report that came out. Case-Shiller just came out this week. This again is a little bit dated because this is the last quarter of 2022, and they talk about the price drop. So this is the home price index on appreciation, and they're calling this the bubble, right? So if this is the bubble, I'm not I'm feeling pretty good.
Mhm.
Like if that's the bubble, right? So yes, we've lost some value, 8.7% from the peak per case Schiller. So to see that, and really it's the folks that purchased from April of last year through today, everybody else has a ton of equity in their homes, and we know that it's going to recover because this was bubble one right here
Oh
in
my
Denver.
gosh.
If I showed you like San Diego or San Francisco, it's like the cliff.
Oh, it's awful.
But in Denver, we really recover quickly.
Yes.
Because this continues to be a strong market. So we recovered by 2012 on those home prices, even if we lose this 8.7, or even if it's 10% or a little bit more in recovering that is to short term, and nobody's day trading homes. We continue
Nobody's
to talk
day
about
trading homes.
that.
These are long-term investments.
So being able to have these conversations, yes, if you want to define a bubble, let's talk about the fact that we have lost some value since the peak to today, but we still have the opportunity to get into the market, maybe even more so, right? Because interest rates have popped back up again. Some of those buyers, we saw it because the mortgage purchase applications are down. They're backing out. They're staying on the sidelines. They're going to come back in. They didn't disappear. They just chose to rent for a little bit longer. In a couple of months or 6 months, when their lease is up again, they're going to come back in the market. They're going to continue to push those home prices stable. Even if we sit here somewhat flat for a year, we'll start building that back up again. Remember, so last week or the week after, we talked about the 100 economists that talked about the average of 4.5% appreciation nationwide for the next 4 years. And remember, we run a little warmer than nationwide. So that's continued opportunity. But in the meantime, you want to talk about bubble or not bubble, the headlines are not headlines. Foreclosures are not the thing. You have one short sale that you know about right now.
One short sale in my pipeline.
One short sale. So the foreclosures are not it. Total number of foreclosure pre-sale 0.45%. Very, very small. And if I look at Colorado, we've actually bounced down. So we've been hovering between the second and the third and the fourth position from the bottom. So really the strongest position to be in across the country. And so now we're back to the second from the bottom. So we're just incredibly strong when it comes to non-current and or foreclosure starts across the country. So when we hear those numbers nationally, remember that our local numbers are much stronger, especially since we've got 91% of the mortgaged homes, 30% here in Colorado don't have a mortgage. 91% of those that do are locked in under 5% with a mortgage that really works for their budget, right? So we're talking stability. The Denver market also has strong buyers. So interestingly, when we look at the statistics, they're putting an average of 22% down, and they've got an average credit score of 742. Just continuing to go into the fact that they're going to be able to refinance. They're going to continue to be stable. They have plenty of equity in those homes. The average buyer in Colorado is extremely strong and will continue to support our housing market. And overall, the strength of the buyer across the country is strong. People want to talk about the fact that, yes, there's some non-QM loans out there, some bank statement loans, the DSCR loans, but overall, we have 103, and this is on the Mortgage Credit Availability Index. And it's like, what does 103 mean? Well, it's compared to 868 on the index scale. Based on a set point in time where they measured it at 100, we have a very low risk of credit failure. What we're seeing in the credit failure side is the banks, not the borrowers. We're seeing banks who aren't able to support. When we see this kind of rate volatility and you have margin calls and you have a secondary market that doesn't have an appetite for the higher interest rate mortgages, you have a lot of stress in the financial markets itself with the lenders, not the borrowers. The borrowers are very strong right now. And then coming back to the fact that this is kind of one of those topics that's always good to remind your database that during recessions, we continue to see home prices go up because interest rates do go down. We have this impending recession, whether it's a hard landing, a soft landing, and now they're calling it a no landing, which just really means that they're going to be pushing it out towards the end of 2023 or somewhere in the beginning of 2024, which could mean it could continue to lock down consumers, drop down the spending, drop down inflation, and then drop down our mortgage rates, which is going to bring out more demand and push home prices back up again. That's a math equation.
Yes.
That's a financial math equation.
It is.
But so the conversation is, how do you continue to have conversations around the strength of investing in real estate, whether it's as your primary home, a second home, or as an actual investment? So what are you looking for? How are you protecting yourself? How do you get in? What are those first steps? And we continue every single month on the second Thursday evening, we continue to do Building an Investment Empire. So make sure that you and your clients, I have a lot of agents that send their clients every single month. So coming to this, and we're also starting to do it for different real estate groups around town, where they're bringing all of their clients to a specific evening event where they're just hosting it themselves. I'm coming in and doing the conversation. And I would love to do more of that, because I honestly think that this is our job. Like, this is what excites us. I know it's what excites you, because you get so excited about it. But having the conversation that strips out the fear and helps buyers get in, right?
Yes.
And sellers
It's all about
too.
knowledge. All about knowledge.
And then sharing that knowledge. Just continue to subscribe to our YouTube channel, where we do a ton, and of course our Friday updates. So we're gonna stop sharing our screen, see if we have any questions.
Got a couple questions down there.
It's still a great time to do this. All right, why don't you go ahead?
So Larry Kendall said on a call, when pricing, don't use comps, use competition. I think that's probably a pretty solid strategy. I would go along with pretty much anything that Larry Kendall has to say. That man's a genius. And so I think that that's a really good strategy to do, but I would also consider looking back a year ago, back to January for your comps, and exclude that big run up that we had from February through April or May of last year. But looking back at those comps from January, adding 1 or 2% is probably going to be another strategy that you can use to look at your comps.
Because it's good to look at competition, but you got to start somewhere.
Yeah.
You kind of got to start.
Well, what if you don't have any competition?
Yeah.
I mean, there's some areas where people reach out to me and they're like, I have no idea how to price this property. And I'm not an expert in pricing properties.
Yeah.
I can tell you overall trends, but I can't tell you how to price a property. That's where you guys have me beat. So how do we get that text about interest rates?
So if you text update to 855-930-0377. And I will tell you, I used to actually send out a rate grid, and it's so complicated, especially with all the changes happening to the Fannie Mae and Freddie Mac grid line, that we start talking about, you need to know that this week we're seeing an 1/8 higher in rates, an 1/8 lower in rates. We're seeing rates are flat, because I'm assuming that you've been talking with your client, who's been talking with the lender, hopefully me, and giving them what their range is based on their scenario. So
Question from Jill. Megan, in 2013 or 2014, you shared a graph as to how we recovered from the 2008 through 2010 bubble. Do you still have it? I don't know which graph you're talking about. There are so many graphs that I've made over time that I'm not quite sure which one that is. I don't know if you have a copy of that old report. I was with a previous title company and I couldn't carry over any of the research that I did at my previous title company at that time. So if you happen to have a copy of that, let me know what that is. Email it to me, mller@firstdam.com, and I'll see if I can try and whip something up for you.
People are asking for the phone number again, 855-930-0377. And we do email. So Megan emails her PowerPoint slide deck right after, and the copy of the recording. I send this out, and we put our slide deck in our Agent Ignite Facebook group. So in that email, we will make sure to have that number.
What's
again.
That number again? They want it in the chat.
855-930-0377. There you go. Okay. Oh my goodness. So much to talk about. Guys, like, this is the opportunity that actually opens doors to sales. This is like, when you're trying to sell something, don't be the salesman, be the communicator, be the educator, right? Because the moment you start selling me, I'm checking out.
Yeah, I can't stand it.
No, but
for being a salesperson, I really hate salespeople.
Salespeople do.
Really can't stand
I'm gonna
it.
stop you right there.
No.
Yeah, I look calm, but I've already slapped you.
I've already slapped you 3 times.
So don't do that. Take this. This is why we do this. We are passionate to serve. And we know that with the education, with your ability to communicate what's happening out in the market in a way that doesn't breed stress, but brings a pathway towards home ownership and or moving. That's that seller that's stuck, that needs to know that they have options. It's the buyer that needs to know that this is the ability to get in, that they can refinance. And you can't guarantee a refinance opportunity. We can't guarantee that interest rates are going to go down. Make sure it works for them today. But then we all know at some point, when inflation drops from its high level right now back down to 2%, that absolutely will have an impact on interest rates. but get them having the conversation and out of being stuck, and do it with education.
Mhm.
Yes.
Exactly. Very well said. Well, thank you so much for tuning in this week, guys. We're going to let you go a couple minutes early because we've run over a couple minutes for
We did.
the last few times. So we're going to let you guys get out of here early and get on to recess. We are skipping next week. Nicole's going to be out of town at a convention, but we will
Yes.
be back at it the week of, I think it's March 16th is going to be our next market update. I'll still publish the reports as we usually do. And so you'll see that come out for me. I might get it out on Wednesday since we're not doing the market update, and I might get that out early. But we'll see how early I can wake up on Wednesday morning. Usually it's 4 o'clock on Wednesdays. So we will see if I can get that done for you or not. And hopefully we'll see you guys back here in 2 weeks. Thanks so much for tuning in, and we hope to see you at our closing tables soon. Bye, guys.